Good morning, Debbie Thomas here. Welcome to the second episode of Mortgages Unplugged. I apologize, we have had some technical difficulties. We were interviewing, chatting along, and then realized that our live stream feed was not up properly. So we're back at it. I'm pleased to have join me in the studio today, members of the MBABC board. To my right, we have Geoff Parkin, who is the president. Next to him, Dreyer, vice president.
Thank you.
And finally, down at the end, Jason Suttie. I don't know. I'll get that by the end of the show, I promise.
It's okay.
And he's a board member responsible for professional development. So we're going to be taking about the next 30 minutes to discuss some current issues in the mortgage industry. And I encourage all of you to send in questions. They will appear on my iPad, and I can then ask those questions live, so we can have some interesting discussion. So we might as well get right into it. I've asked this before, but I'm going to ask again. We're now into the spring market. It's officially arrived. Can we expect to see any more rate competition as we did back in February with the 299?
I think my sense is we're probably through a bit of the aggressive rate competition. I don't necessarily think all the lenders were really interested in playing in that 299 field, and they were there for defensive purposes to protect their pipeline. And so I think from my perspective, they're probably going to ease off of that for the next little while. We saw some sort of messaging from the Bank of Canada yesterday and the last couple of days that they're indicating we are going to start to see some rate increases over the next year to 18 months. Nothing imminent, but my sense is that that'll probably keep the banks sort of holding rates where they are.
Okay. Jared, would you like to add to that?
Yeah, I would tend to agree with Geoff. I think they're going to wait to see how all the fundings go from all the pre-approvals, the rate houses that all of us have got out there, and make sure they're done to the end of May. So I think they'll wait till probably the end of May to see how the results have been,
right.
And then based on also how the new volume is coming in. The good news is, of course, the bond yields are starting to get down, so we have started to see some lenders decrease rates, and there is some more movement on that part of it, but I'm not expecting any more specials or anything till probably June sometime.
Okay, all right. And Jason,
Yeah.
would you think that it's a typical spring market out there? Do you see it a little busier, a little less? You're out in the valley?
Yeah, I'm out in the valley, and I would say it's typical in the sense that we've seen the volume increase over the first quarter like we always do. Not maybe the gangbuster springs that we're used to over the past couple of years, but nonetheless it has picked up, and a lot of things on the market. I'm finding actually more than anything else it's balanced. You got the right amount of sellers and the right amount of buyers.
Perfect.
Yeah.
Great. All right. Let's move on now to some of the mortgage rule changes that have occurred over the past several years, and we were delighted to hear in the budget, was it last week or 2 weeks ago? I don't know, time flies, that no more rules were going to be implemented in the mortgage industry. So what do you think that means going forward? Are we safe for the next little while? Jared?
Well, I think they didn't implement any rule changes, but as we're finding out in the marketplace, and we were discussing just before this, is that deals that where the lender are approving right now, and they're sending into CMHC and Genworth are changing their own rules and
Right.
coming back. So I think even though we didn't have rule changes that are guidelines, is we're now having sort of non-moving targets. We don't know what's going in. For example, we just had a deal that was approved by the lender and was sent in, and CMHC and Genworth both came back saying they wanted 10% down or a strong cosigner, even though the bank approved it and wanted to get to the deal. So
Right.
I think more than ever we have to let our real estate partners and the clients know that they need to put in the subject to financing clauses. They need to make sure that the deals are going to get through, because we're going to have sometimes on those 5% down deals we may have a different answer back.
Okay. Now we have a third insurer,
Yes.
Canada Guarantee. Do you find that you have any influence as to where you would like your deal to be sent if it has to be insured? Or is that door kind of slammed?
I think you can always ask. It doesn't necessarily mean that the lender's going to do that. With their programs, they sort of have a preference for insurers, and so to a large extent they'll do that. But in certain cases, if you've got a deal that's a bit complicated and you've had a chat with one of the insurers to see if it's feasible, put that in your submission notes, and I think the lenders are open to that, where there's been some sort of discussion ahead of time. So I think there's some flexibility, but it's ultimately the lender's decision.
How many lenders out there use all three insurers? Do we know?
Well, Canada Guarantee being the new one on the block, it starts to increase, and I believe it was 1 or 2 weeks ago that Scotiabank announced that they would start using them. So
I think Bridgewater also uses all three.
yeah. Bridgewater being an insurance-backed, people will probably be always on the forefront of and using insurers, but I think you're going to find most people will now use all three. It took that one barrier to break down. I think once Scotiabank opened the door, you're going to see all the bigger banks use all three and go from there. So I think we'll see most of them. Most of the mortgage banks use all three.
Okay. Realtors that are out there, your referral sources, are they sort of solid and understand all of these rule changes, or do we still have some education to do to pass that on to our realtor sources?
I think there's a general knowledge. I think, as Jared kind of mentioned, I think there's a little less certainty about what will go through and what won't go through. I mean, it used to be relatively simple. You could say it fits the program and it's straightforward. It seems to us that there's a lot more judgment on the lenders and insurers as to whether or not it actually will squeeze through. And so, although it used to be more predictable, I think we're finding there's a lot more uncertainty about deals that are kind of on the edge. And so, I think the message out to the realtors is make sure you got the subject to financing in. And the message I've been getting out, if I'm looking at the client ahead of time and I think it's a bit of a tight deal, give me an extra couple of days.
Okay.
Because we're sometimes finding we have to go to a couple of insurers or a couple of lenders to try to get the deal done.
Okay. And that's high ratio. What about all of our monoline lenders who still have to bulk insure? Are you finding any changes in what's now being approved and what's not being approved?
I think it definitely also too, I think one of the key things on that is you have to look at what the property is. And I think that's one of the key things is, especially when it comes to strata units, they are starting to look at more details, which they always have, but they're looking more in the strata minutes, property disclosures, if the values on that side, any type of the properties. So, again, to reiterate what Geoff's saying, I think, for the subject to financing clauses, it should be now going towards at least 7 business days, I think that is more appropriate in today's marketplace.
All right.
I think we're seeing more challenges on the higher pricing as well. If you've got some of the properties in the $1.5+ million range, which is not uncommon in Vancouver now, those are getting a lot more scrutiny.
Yeah.
And one of the things we're finding on those is if they are getting appraisals, we're going to find out that a lot of the value is land value, and there's not a lot of value assigned to the houses. And so that's creating some challenges with lenders because they said,
Right.
really it's not the kind of property they want. So
Particularly in the refinance market. I mean, we were talking earlier about how that is really booming at the moment, and everyone always feels their home is worth more than they actually are. Have you seen appraisals softening a little bit, value softening a little bit?
Absolutely. And I think the one challenge to tie that in with the appraisers is we're seeing more and more non-auto approved deals, and the appraisers actually want to physically send somebody out. One of the nice parts with the new insurers, they'll actually look at appraisers we order. Some of the other insurers will not allow you, but we've even had deals where we've had an appraiser go out and approve a property. Quite frankly, it was a nice property in Abbotsford, and it was appraised at $620. CMHC sent out their own appraiser and appraised it at $540.
Wow.
So there's difference in appraisers too. So I mean, the value, as we've all talked about, is whether it's insured or non-insured, seems to be one of the biggest challenges we're seeing right now.
Okay. A lot of lenders have announced some policy changes that have impact those that are new to Canada, those that are self-employed or stated income. What advice can you give to brokers on how to, advise these clients or where to go for financing?
I think it certainly is getting a little bit tighter, and I think what you're finding is there's a lot more scrutiny of sort of the income that we're presenting. It used to be that if there was a reasonable amount of equity, you could kind of go through on a stated income. What we're finding is that the stated incomes, they're looking for more backup. Can we see corporate financials?
Right.
Can we see the T1 generals and statement of business activities? A lot more of a test of what's reasonable. I don't necessarily think that's a bad thing, but I think it's kind of going to create a little bit more challenge for brokers to get that paperwork, do the due diligence up front, make sure that you can support the incomes, and that it's reasonable. And I think if brokers do that groundwork, they'll be able to get the deals through. But if they're just hoping on sort of throwing in a stated income deal and crossing their fingers, I don't think that's going to work.
Well, I think a lot of the auditors, their internal auditors, Scotiabank, the TD banks, have really put a strong message out to all of the underwriters that we want more documentation. So we've noticed here in the office, new immigrant files, for example, we'd be able to throw them in, somebody making $200,000 a year, somebody had net worth of $500,000. Now we're being asked to prove that, whereas before it just flew through went under the radar.
Yeah, and I think that's also due diligence that the lenders are doing, which is, there's nothing wrong with that. I think it's on that side of it. I think also the key aspect is you have to be prepared, and I think we make the client prepared that they're going to come back and ask for more money down. And I think that's the key thing that we're finding is that, 75, 80%, maybe now cut back to 65, 60% on that marketplace. So again, it comes back to come back with Geoff talking thing. You really got to spend the time with the client up front now, more than ever, to make sure that you go through the different scenarios, get all the documentation you can before going out into the marketplace and shopping it with your lenders.
Okay.
A lot of the challenges we also see in the new immigrant is that a lot of the income that they are reporting to us is still offshore income.
Right.
And that can be quite difficult to prove, unless you can read sort of different languages. It's a challenge for us, certainly. What we see some lenders trying to do to compensate for that is asking for cash reserves. And so they'll ask for a certain amount of money on deposit in Canada so that they can support the numbers and know that there's cash flow there without necessarily having to rely as much on offshore income.
Okay.
So.
All right. So that might flow into OSFI apparently has put a draft document together to send out to financial institutions. Can you give us some insight into what that's all about?
OSFI is the federal regulator for financial institutions, and they put a document out a couple of weeks back talking about some proposed changes to mortgage rules. And so this is different than what we would have seen through the federal budget. There's a couple of areas in there that are going to be quite contentious. There's some minor things like they're talking about adding home insurance cost into debt servicing. Minor issue, not significant. They're also talking about totally eliminating cashback mortgages. Particularly, they're focusing on the zero down programs, because I think the intent from the rule changes by the government was to try to kill those programs. They are still available through some of the cashbacks, and so that's an area of discussion. There's two areas that are a little bit more contentious. One of them is with respect to home equity line of credit products, and the suggestions there are things like reducing the maximum loan to value on a HELOC to 65%. Or suggestions like looking at forcing an amortization of a HELOC after the first 5 years.
Okay.
I think the message there that concerned that people are using the HELOC as an ATM to buy the big screen TVs and getting themselves further and further into debt. There may be some clients that do that, but I think the vast majority of them are using them well. And so, from my perspective, I don't think that's necessarily the right target. Perhaps the biggest sort of area of focus that we're looking at is the renewal process. And the suggestion in this document is a couple of things on renewal, which is that at renewal, the lender has to totally refinance the client rather than just do an automatic renewal.
Or requalify.
Requalify the client. And that may or may not be good. You could have a situation where somebody's made their payment perfectly for the last 5 years, but they've gone out and bought a truck, or their income has changed, or they've gone self-employed, and they no longer would qualify at renewal.
That's right.
The big question there is, and what happens if they don't qualify? Is the lender going to call a mortgage? I mean, that's the test on it. Part of that requalification process also suggests that they may ask for the property to be reappraised at renewal date. And again, that kind of brings up the issue of, so what happens if we find that the property value has dropped and the lender's now at 105% loan to value? What does that mean? Would that mean they call a mortgage? If that's the case, there's no other lender that's going to pick it up. So that's an area that I think we're all kind of concerned about, and we're going to be providing feedback.
That just can't happen.
Yeah, I can agree with you, Debbie. And I sit on the government relations committee for CAMP, and of course CAMP does have a government lobbyist that they had, and they have a draft proposal that they're working on to present to it. And that was our major concern across Canada with on the relations committee, is that it varies from area to area, but there are still property values that haven't gone up from the crash of '08. So there's still people that are underwater, but are making their mortgage payments. And where does that put that person, right? And I think I agree with you. I think that's the major concern and focus. I also think that OSFI, they have already talked about last week about changing the line ELOC program down to 65%, the regulator. And I think if they get control of CMHC, which it seems like the government wants to do that, I think it's going to be a give and take between the banks, and I don't see the renewal thing happening, but I do think that the ELOC will get cut back to 65%. I think it's going to be a bargaining chip that they're going to leverage for both of it, in my personal opinion.
So for example, Merrick's has the 50-50, that will still be fine, but you've got your STEP and your matrix and all of those that will either have to be cut back, I suppose, or canned altogether.
Yeah, that we probably cut back to 65%. You know, so but it's going to limit. The thing about the e-locks, which we talked about too, is from the bank's perspectives. You know, for the TDs, the RBCs, and the Scotias and CIBCs of the world, it's a big tool for their financial advisement community. So they're for the branch network. It's a huge tool. You know, to help people tap into their equity to reinvest. You know, with their financial advisors or their Waterhouse group. So it is a big thing if you go drop it down to 65%. But OSFI seems really intent that's where they're going to be heading. And I think it's really more of a political front that they want to show that, you know, the world that Canada does have their finances under control versus it's really a problem because arrears and everything are still at all-time lows. And that's the biggest thing that I think needs to be presented to the government. Because we're not in a housing crash bubble. People are making their mortgage payments. We don't have high arrears.
Well, I remember the Maclean's magazine, a couple of months ago, where the front cover was doom and gloom.
Oh, they've been saying that since 08.
Yeah.
And they've been saying that since they published the magazine.
Yeah.
Right, right.
My concern on the HELOC issues, I think what, again, government is concerned about and the regulators are concerned about is the amount of consumer debt. The reality is a HELOC is actually a good tool to help people correct the consumer debt challenges.
Right.
Changing the HELOC is not going to change the issue which started it, which is the spending behavior.
19% interest rate.
And I was going to say, you know, you can go get a $20,000 credit card. You don't have to provide a stitch of income proof. If you have a decent credit score, you're approved. You can go get a car loan or a lease payment. It's not uncommon for us to see $800 or $900 lease payments without a stitch of income proof.
Right. Yeah.
And in, like I guess it's easier because there's tools in place to regulate the mortgage market. There isn't necessarily tools in place for the government to regulate that consumer debt market. In my opinion, that's where the focus needs to be. Put more controls on consumer debt. Make people show some income if they're getting car loans, car leases, $20,000 credit cards. That's I think how to prevent the problem rather than trying to restrict a correction to it.
So on the board that you sit on, the federal, what's the board?
Government Relations Committee.
Government Relations. So I would assume that's you guys are all trying to hit that home.
Absolutely. I mean, they have a good draft response that they just got put out, and you know, and they're working very hard on that part of it.
Right.
And you know, Camp has hired a lobbyist, who is in Ottawa, so they've hired a lobbyist group. So they're working very hard to make sure that the message is heard. You know, but again, the reality is the banks are really in control of it. You know, I mean, it affects them more. So I think that's kind of what is nice here. This is going to, yes, it can affect the mortgage brokerage community, but it's also going to affect the financial institutions committee. So the financial institutions are going to be working very hard to make sure that it doesn't affect their business.
Okay.
Yeah,
It'll affect their bottom
I do
line.
know that all of the associations, Alberta, Ontario,
Yeah.
British Columbia, Camp, we're all kind of doing the same thing. We're providing that feedback. And I think we've all had the same reaction, which is that you know, some of the stuff they're talking about is a very dangerous approach to things. So.
Yeah.
Yeah.
So getting back to, you know, local, Jason, there seems to be a renewed interest in a 10-year fixed term. Do you want to talk about some of the pros and cons or advising someone if they should take a 10-year or not?
Well, I mean, some of the pros are, I think, fairly evident. You have long-term security at a low rate. I mean, if you were to take an average, I think a couple of years ago we did an average of the 5-year rate over 50 years, 5-0, and it was something like 7.23 or something along those lines. And so you do have the long-term security, although you do end up giving up a little bit of flexibility. So I think the key is whether it's a real nice 10-year or a variable rate, it's always going to be about knowing your client and we talked about self-employed people and chatting with your clients ahead of time. So important to find out what their goals are, what they're going to do. There's a lot of fear at renewal about if people are going to be qualifying. Well, if someone is maybe going to is planning on building a family, that means mat leave, that means less money. Maybe they should be in a 10-year so they don't have to requalify and things of that nature. Or the investors. I think the key is it's really hard to put a paintbrush on whether it's a 10-year or any product whatsoever. It's got to be know your client and advise them on what's the right product for them. In my personal book of business, I would say I've maybe placed 4.
399 out there right now, or even 389,
Yeah.
is right for certain people, but
Absolutely.
then again, it's not. What do you
Yeah.
advise your clients on a 10? What do you talk to them about on a 10-year?
Well, I think on a 10-year product, I think it's like anything. You have to. The advantage with us is we represent all products. So I think that's the key thing. Is that what you have to do with any client is you spend the time up front with the client, get to know your client, get to know what their habits are, and also get to know what their future is. I think that's what a lot of brokers make the mistake is they're looking at today's situation versus, okay, well, what do you have any plans for the future as well? And I think what you're trying to do then is to advise them of what the best option is, whether it is going to be a variable rate with a great pay down strategy, whether it's maybe even a shorter 3 or 4 year fixed rate term that is very attractive right now, or if it is a 10-year fixed rate. And then explain what the best options are each term, so that way the client can make an informed decision of what they should be taking.
Okay.
And I think that's the best way to approach it.
I have a lot of clients with revenue properties, and personal perspective, but I think something like a 10-year rate right now is a great product for a revenue property. The real benefit of sitting on a rental property is that you get long-term capital appreciation. If you can get the cash flow kind of close to cash flow neutral and just let it sit there, that's where you make the money. You know, the 389 or the 399 maybe is a little bit higher than they want to pay. However, on a revenue property, it is tax deductible as well.
That's right.
So the pain on that is kind of offset by a tax deduction. And so for people who have a long-term buy and hold strategy on revenue properties, I think it's a great product.
Okay, well, and I think historically, if you look back, people who have taken 2 5-year consecutive mortgages have paid less interest than those that have taken a 10-year.
Correct.
But that's we've never had 10-year and 389 before.
Yeah.
So going forward, I think one of the pros also you have to inform your client is that once you pass that 5th anniversary, you don't have the IRD anymore, right? Because of the Interest Act. So you've only now got, it's like a variable, you've only now got a 3-month interest if they decide. And they can port that mortgage.
Yeah.
And that mortgage could be assumed. So it might be part of your selling strategy down the road that you've got this great mortgage, in 5 years that all other rates are up in the 6% category, and you can sell that home with the 399.
Yeah. No, I agree with all those points there, and I think it comes down, if you inform them of those points, it comes to an individual decision, and it depends if the client wants to pay that extra money now for the insurance aspect of it, and that's what it really comes down to, is do they want to pay that extra monthly installment for the insurance factor of having that guaranteed. And it does make a lot of sense. Unfortunately, I've been around a long time where I've seen where we started with 5-year rates were 9.9%. So I mean, these are, people have to put in perspective. These are the lowest rates we've ever seen.
I was going to say, Mike,
right? So
the direction I get from clients is 2 extremes. Younger clients, the sort of instant reaction, well, that's not a very good rate. And older clients, their perspective is, really, for 10 years? That's actually really good. So, it's kind of funny, you just get extremes on the response to it.
Now, you 3 are all very successful in your business. What do you think, Jason, is? Do you focus differently in the spring market, or what can you give? What advice can you give for brokers out there wanting to build their book? Do you do anything additional in the springtime, or is it just your marketing plan that hits everyone on a regular basis?
My marketing plan personally hits everyone. It doesn't change all year round. As the professional development person, this is actually pretty close to my heart because I do teach the applied information course to very new brokers. And the one advice I could give to anybody is it's kind of twofold. Number one, pick up the phone and call your clients. More than anything else, it's real easy to get caught up in social media, email, but nothing beats the phone, and nothing will. And do it often. That's the other part too.
You strike me as a guy that really enjoys chatting with people.
I'll chat with myself, but quite frankly, it's one of those things. What we saw when the markets crashed. What I saw with a lot of financial planners, where the complaint was, I haven't heard from my financial planner, I haven't heard from my financial planner. And the financial planners that did well, sometimes they didn't have great news, but at least they called. And I think that's a lot of times is just being top of mind and calling your clients, advising your clients, being in contact with them. And then finally, asking for that referral. We're in a referral-based industry. And the old adage just stands true. If you want the business, you need to ask for it.
Okay, Jared, you want to expand on that?
I could agree. I agree 100% with Jason. I think now's the time where you should have a scheduled program. You should be calling your clients every 90 days. I think on that side, your database should be every 90 days. I think you can have a check-in with them every 90 days to see how it's going. I think it gives you another opportunity to ask if they know anyone who's that needs their help right now. If they don't need any help, because people are changing all the time. So you never know when mortgages are kind of a latent need. It's only when the client needs you that they're going to pick up the phone. Otherwise, they don't really think about mortgages at all, right? When payments come out automatically, we never think about it again. So you have to keep on top of them, with their visibility, to do that. I do think, and that's one of the key words that I had even talked with our own team yesterday, was you have to increase your visibility. I believe, in this thing. And I think, social media is another way that you can do it. I've mentioned it before, it's free, and you can increase your brand. But, really you need to step up your visibility, not only to your past clients, but to your referral partners and to everyone else as well.
So we do have a lot of open houses. I mean, in the spring market, traditionally, when you guys first started, did you, pop into those open houses and try and, present some feature sheets or, that's a long time ago, but it used to work. Does it still work?
I think when you first start, you do just about anything to get a deal. Honestly. And so, if you would do all of that. And I think, it's kind of one of those things when you're starting out and trying to build a client base, do everything and anything you can to get the leads, to get your face out, to get the referral sources. Open houses are great. Sometimes you just have to make sure that, in many cases, a realtor will already have an existing relationship with a mortgage broker. So you got to be kind of aware of that going in. But I think from my perspective, there's no wrong way to get business. Just get out there. They talked about talking with your clients, and I agree with it. And I have a couple of programs that I work, and I'm very specific on. I'm not a big believer in just calling the client to say hi. I have to have a reason. And so, for the last 3 months, if you haven't been talking to your clients to talk about refinance opportunities, you're kind of missing the mark. I think from my perspective, that's been a huge opportunity. The rates the way they are, it's been the easiest sort of way to open the conversation. If they're not interested in refinancing or something like that, that's not a discussion point. The next thing I talk to them about is increasing their payment. I'm a big believer of, just increase your payment by $50, and I'll phone you next year, and next year we're going to do it again. And it just gives me a reason to have a chat with them about something, and it's a meaningful conversation. So.
All right, good.
Yeah.
We've had a question come in about rate buy downs. The industry, there are certain, I guess, programs out there, or certain companies perhaps that really hit buy downs and then advertise rates that are sort of below the norm. What's your comment on that? And does it hurt? And we as
Can we do it in unison?
as a collective group need to be strong against that. Comments?
To me, it's pretty simple. It's rate in our industries are price, and it never boils down to price. It always boils down to value. You can use, I don't know how many cheesy sales lines there are. No one drives the cheapest car. Why? Because there's something else they're looking for, and I think that's the same with the mortgage. If you're going to just sit there and take an application and put them into any product and not really do anything with the client, then you deserve to have to buy it now, because to me, you're not doing your job. As a mortgage professional, you need to be advising your clients. You need to be showing them the value. Geoff brought up a great point about adding money. I always ask, one of the questions I ask every person when they say, what's most important to you, 90% of the response is rate. And then I ask why, they don't have an answer. Because typically what most people want to do is acquire their home for the least amount of money as possible.
Yep.
And does that mean rate or not? And people don't understand. So if you can walk them through that, you get off the rate subject really quickly. I believe wholeheartedly in my service and what our company provides to clients. So, and I think the value's there that we shouldn't have to buy rate down.
I agree with it. I think the rate buy downs they're going to be a factor. I think unfortunately the lenders are the ones who are creating that animal. It's not necessarily the brokers are doing it. And unfortunately there is, brokers have to do whatever it takes sometimes on that side of it. And I think I understand the philosophy behind it, and I think sometimes I understand the client of it. And if we want to really lay any blame to it, let's lay blame to the internet. The internet is really the problem for it, right? Because everyone can shop a rate online if you're looking on rates. I think what the key thing is, though, is the consumer is a lot more educated now, so they understand. So if there is a rate buy-down program and it's with a lender that they don't necessarily like, I think that's where our skills come into play, is that you're telling them, well, here's what the rate buy-down is, here's who the lender is, here's what their options and prepayment privileges are. Do you want to work with that, or would you versus want to work here and pay 5 or 7 basis points higher? I think you'll find the majority of clients don't mind paying 5 basis points higher to deal with a grade A lender.
I mean, we as a group, there was a lender that offered a great rate a while back and cut commission in pretty much half. So collectively as a group, we were, I think, trying to not send business that way, to send a message. Do you think we were successful in that? Or I think there's still maybe enough new brokers out there that don't get the big picture and fired off the deals to that lender?
It's always a challenge because there's, with the 299s and the 298s, there was a lot of marketing that went out there. And so the clients were aware of the rate. And so it does create a challenge for you as a broker to say, well, you know, I want you to get this rate. Well, yeah, but what about this 299? When you're talking to the client, that's really difficult to say that, you know, I don't want to send you that way because like their products are great, but it's just not the best thing. The reality is it's an issue of commission. Kind of puts the broker in an awkward spot. However, I think when you're looking at those reduced commissions, I think most of the brokers are going to look at that and think long term, that's going to be pretty tough to be successful in a career when you're working for half the pay. I think most of the brokers in our team kind of had the same reaction. It's like, you know,
It's like going back 15 years.
yeah, and they
Yeah, with more expenditures than you had 15 years ago.
Exactly.
You know, and the way lenders are. So I tend to agree with that. But I think it really comes down to is brokers aren't spending the time with the clients to get the strategy. And I really agree with that
Right.
because, you know, when you spend the time with the strategy and, you know, a perfect example, I had a client that was BMO, the BMO 298, we had the TD 299. They ended up taking a 3-year 279 because that was the best product for them, right? You know, in that
Yep.
option. So you have to explain that and talk to and go through that. And I think what happens is most brokers want to speed the process through, get the application done, you know, and especially if they haven't been doing it a long time, they don't actually say, okay, well, I'm going to spend 20 minutes, half an hour with my client up front and during the application, ask the questions, get the information, be an advisor. And I think the more, if we have to go to an advisor role, and I think even more, an advisor role has to be paramount first.
Okay, great.
I agree.
Good
I mean,
advice.
one of the things with taking the application too is really getting beyond it. You can get, it's very easy for someone to write down a social insurance number and an address and get those asset things. It's, as an advisor, it's asking those deeper questions, those open-ended questions, and finding out really what the goals are for the client.
Great. We have an MBABC conference coming up. Would you like to, when is it? Let's remind everybody.
Yeah, it's May 7th and 8th. It's in Vancouver at the Fairmont downtown,
Okay,
Hotel Vancouver. And registration is on the MBABC website.
all right. And I guess early bird registration is done? Over?
I think it is, yes.
Yes, it is, okay.
We're looking for an all of it. It's going to be a great conference. You should come out and support it. You should always come out and support your industry.
Right.
So I encourage everyone to do that. We've got the Deputy Governor from the Bank of Canada. We have a fantastic panel coming. So I really encourage everyone. And it's one of these conferences, too, where you don't even have to come down for the night. You can just come down for the day on that side of it. So it's going to be very well intended. So come support your industry.
There's
Great.
a trade show in Well. There's, I think, just about 60 companies that are coming to present at the trade show. So in terms of brokers being able to have access to all of the lenders and market suppliers and
Right.
appraisers, that's the place to get it.
Okay. And there's elections for board members?
Correct.
How many
Open
people?
yesterday.
How many people are running? And there are 5 positions available.
Yes, there are
Yep.
5, and
Yes.
I think the number of people running is
8.
10, something in there.
Yeah.
I'd have to go
8 or
look at the
9,
list.
8 or 9.
Yeah.
So make sure you vote as well, of course. And if you're in the by-elections, make sure you vote today too, right? So
Right,
you have
right.
votes, yeah.
Great. All right, thanks very much, gentlemen, for joining me here today. And I do apologize for our slow start this morning, but I just want to remind everyone we'll be back again on May the 17th for the 3rd in the series of Mortgages Unplugged. And we're going to start on that day at 10. And so hopefully we'll have all of the technical issues ironed out by that time. So until then, thanks for watching and have a great day.